What caused the 2008 financial crisis? If you ask most people, they'll say it was a housing collapse or just risky banks being greedy. But that's not the whole story. The truth is far darker, more systematic, and reveals how the entire global economy was turned into a ticking time bomb. The crash didn't just happen in 2008. Its fuse was lit years earlier, when Wall Street discovered a terrifyingly profitable new business model, selling risk disguised as safety. And for a while, the whole world bought it. It all started with a simple idea that became corrupted. Banks realized they could make immense profits by getting people into homes, even people who couldn't really afford them. The system wasn't just about financing the American dream anymore. It became about weaponizing it for profit. At the very heart of this were subprime mortgages. These were loans given to borrowers with poor credit histories, people who were seen as high risk. Normally, a bank would be very careful about lending to them, but something had changed. The banks didn't care if these borrowers could actually pay back the loans. Why? Because they had no intention of keeping them. Instead, they began packaging these risky loans together through a process called securitization. They took thousands of mortgages, some good, some bad, many terrible, and bundled them into complex financial products called mortgage-backed securities, or MBS. But they didn't stop there. They took the riskiest parts of those MBS and bundled them again, creating even more complex instruments called collateralized debt obligations, or CDOs. Imagine taking a pile of rotten fruit, blending it with a few good apples, putting it in a fancy jar, and labeling it gourmet organic fruit smoothie. Then, you convince the world's most sophisticated investors that it's the healthiest thing they could possibly consume. That's exactly what Wall Street did. And here's where the system truly broke. The job of a credit rating agency, companies like Moody's, Standard & Poor's, and Fitch, is to be the world's financial watchdog. Their job is to assess risk and tell investors what's safe and what's not. But during this time, they became part of the problem. They started stamping these toxic, rotten fruit CDOs with their highest possible rating. A. That's the same safety rating given to U.S. government bonds, considered the safest investment on the planet. Why would they do this? The answer is simple and disturbing. The banks paid them for the ratings. It created a massive conflict of interest. If one rating agency refused to give a good rating, the bank would just take its business to a competitor who would. It became a race to the bottom, where honesty was punished and deception was rewarded. So you had investors all over the globe, pension funds managing your retirement, city governments managing public money, even foreign countries, all buying billions and billions of dollars worth of these supposedly ultra-safe investments. They had no idea that they were built on a foundation of sand, on mortgages that were starting to fail at an alarming rate. But the final ingredient, the one that turned this from a problem into a global catastrophe, was leverage. Banks weren't just investing their own money. For every $1 of their own capital, they were borrowing $30 to make bigger bets. Think about that. It's called a 30-to-1 leverage ratio. It meant that if their investments went up by just a little, their profits would be amplified 30 times over. But it also meant that if their investments dropped by just over 3%, they weren't just losing profits. They were completely wiped out. Their entire capital would be gone. Lehman Brothers, for instance, had a leverage ratio of 31-to-1 right before it collapsed. And that's exactly what happened. In 2007, the music stopped. Home prices, which everyone assumed would go up forever, started to fall. The people with those subprime mortgages couldn't afford their payments, and they couldn't sell their homes for a profit to get out. Defaults skyrocketed. Suddenly, those AAA-rated CDOs weren't worth their fancy labels. They were filled with worthless loans. The dominoes began to fall, one by one. The entire financial system is built on trust, and overnight, that trust vanished. Banks stopped lending to each other because nobody knew who was holding the toxic garbage. Credit froze solid. The lifeblood of the economy, liquidity, just disappeared. By September 2008, the crisis detonated. Lehman Brothers, a 158-year-old institution, filed for the largest bankruptcy in U.S. history. Merrill Lynch, another giant, was forced into a sale to survive. AIG, the world's largest insurance company, had to be bailed out by the government with $180 billion. Why? Because they had secretly insured over $440 billion worth of these toxic CDOs without having the money to pay out the claims. It was like selling fire insurance for the whole country and only having enough cash to cover one house fire. The stock market crashed. The housing market plummeted. Millions of people lost their jobs, their homes, and their life savings. Global trade collapsed by 30% in just a few months. But here's the most shocking part of all. This was not an accident. It was a crisis that was built, packaged, sold, and insured by the very financial system that it nearly destroyed, all driven by an insatiable hunger for short-term profit and a complete willful blindness to long-term risk. And when the dust settled, who paid the price? Ordinary people. And who got rescued? The very institutions that caused the collapse. The U.S. government and the Federal Reserve stepped in with over $700 billion in TARP bailouts and eventually printed over $4 trillion through a program called quantitative easing. Wall Street got a fire hose of cash. Main Street got foreclosure notices. Before we go further, I want to hear from you. Let me know your thoughts in the comments below. Do you think the 2008 crisis was a systemic failure? Or was it an engineered extraction of wealth? And more importantly, do you believe the same kind of risk is building up in the system today? Stick with me, because what I'm about to reveal is the part that almost no one talks about. We're going to look at how some of the biggest banks knew the collapse was coming and actually placed massive bets against their own customers to profit from the disaster. We'll explore how the system quietly reset itself and why many experts believe we could be heading towards an even larger crisis. So, you think the story couldn't get worse? It does. While the financial system was selling these toxic assets to its clients, some of the smartest people on Wall Street knew they were garbage. In fact, some firms, like Goldman Sachs, weren't just selling these CDOs. At the same time, they were secretly betting against them. They would sell $1 billion CDO to a pension fund, telling them it was a safe investment, and then turn around and buy something called a credit default swap, which is basically an insurance policy that pays out if that same CDO fails. It's like selling someone a car with faulty brakes and then taking out a life insurance policy on them. When the crash they helped create finally happened, they cashed in. They profited from the collapse they sold to their own clients. It wasn't just a failure of risk management. In some cases, it was a deliberate strategy. What happened after the bailouts is just as telling. You might think, after a near-death experience that almost took the world economy down with it, there would be a fundamental reckoning, a complete overhaul of the system. But that's not what happened. Yes, there were new regulations like the Dodd-Frank Act, but many argue these were just patches on a fundamentally broken engine. The core problem, the too-big-to-fail banks, became even bigger after the crisis, as they absorbed their failing competitors. The culture of high-risk, high-reward behavior, fueled by massive bonuses, never really went away. The system that created the collapse was rescued, propped up, and essentially allowed to continue. No high-level Wall Street executive went to jail for their role in the crisis. The fines paid by the banks were, for them, just the cost of doing business, a tiny fraction of the profits they made creating the mess. So the critical question is, could it happen again? Many people will tell you no, that the system is safer now. But let's look at the facts. Today, global debt is far higher than it was in 2008. We're seeing new bubbles emerge, not just in housing, but in things like corporate debt, private credit, and even certain tech stocks. The same kind of complex, opaque financial products that caused the last crisis are being created again, just with different names. We still have a system where leverage is high and risk is hidden in plain sight. The Federal Reserve's response to 2008, and later to the 2020 pandemic, was to flood the system with trillions of dollars of cheap money. This has created an environment where everyone is chasing yield, taking on more and more risk to get a decent return. It's an echo of the pre-2008 world. When money is practically free, people do risky things. The fundamental dynamics that led to the 2008 crisis, greed, complexity, and a failure to price risk correctly, have not been solved. They've just shape-shifted. Understanding the 2008 crisis isn't just a history lesson. It's a user manual for the financial world we live in today. When you see asset bubbles inflating, when you hear about complex new financial products that promise safety and high returns, when you see a disconnect between the roaring stock market and the struggling real economy, these are the warning signs. These are the exact same signs we saw before 2008. The system hasn't been fixed, it's just been rebooted. And the next time the system crashes, the government may not have the same tools to rescue it. The story of 2008 is complex, but it's one we all need to understand to protect ourselves.